Our next guest thinks that the odds of a recession have actually gone down. Join us now, Larry Kantor, operating partner at Atlas Merchant Capital. Because of the Fed or because of something else?
The Fed's the big thing. I mean, I don't think people appreciate how big this shift has been. At the beginning of the year, people were looking at another 100 basis points of rate hikes. Now they're pricing in 50 to 75 basis points of rate cuts. It's a massive shift. Everybody's talking about how the bond market and stock market are contradictory. I don't see it. I mean, you know, if the Fed's now cutting rates instead of raising rates a lot, bonds rally, and stocks have held up pretty well. So, I mean, to me, it's more of a positive message. The second thing is, you know, late summer, early fall, we're going to go back to the debt ceiling and spending arguments. My view is this is going to be resolved by more spending. I mean, we saw Trump meet with Pelosi and Schumer. They agreed on a $2 trillion infrastructure package. That's not going to happen, but it kind of gives you a signal of the direction they're going here. No way, in my view, the White House and congressional Republicans are going to allow tight fiscal policy, which, by the way, sequestration, remember that name, is still in effect today. So if they don't come to an agreement, you get across-the-board cuts. I don't see that happening. So when I add that up, an easy Fed, and I think a lot of the slowing is just you're coming off of juiced up growth in 2018, juiced up by a massive tax cut and spending package. So naturally, now that that's fading, you're slowing.
So what are, when you look at people that are on the look, they're like canary in the coal mine for recessions. That's all they do for a living. And they ratchet up, you know, they're 20%, 30%, and some are up at 40% over the next 12 months.
Right.
It's, for me, it's hard for me to understand. There must be some metrics that they're using in terms of ISM or retail or consumers, because you got unemployment is so low you wouldn't expect a recession. The stock market, unless it's the Fed, the stock market doesn't seem to be forecasting a recession. But then you got the bond market and those crazy sovereign yields around the world that are negative. But I don't know, that may not be us, that may be the rest of the world, and it may be inflation. So there's all these, I mean, history always, it never repeats itself, it rhymes. And it's hard to add up all the different factors that are saying different things. But you come to the conclusion, no recession. Right.
I mean, I'm sort of, you sort of just sang my tune here. I mean, I think bond yields are going down because of the change in the Fed stance. And look around the world. Bond yields are negative. I mean, you know, so
and we're global. It's
where
hard
are you going to go? And now we have a global financial markets and economy and so forth. So I think that's it. Now, when you ask the question, why are people forecasting this? I think one is whenever the unemployment rate has gotten below 4%, which it did over a year ago, you've had a recession within the next couple of years, and you probably know.
From margin compression or something?
We set a record for the longest expansion. So people are adding that up.
But they don't die of old age.
Looking at the yield curve and stuff like that. And look, caveat here. Economists are not, including me, not very good at calling downturns. And the reason is you tend to estimate direct effects, right? When something bad happens like trade, economists are saying maybe this takes a half a point off GDP. That's not why recessions happen, especially in the last couple of decades. It's the indirect effects, the hit to the stock market, business sentiment. There's a lot of leverage in pockets we didn't know about. You remember AIG and the last thing. That's what causes it, and that's pretty damn hard to forecast.